Before we begin, please be aware that the content in this presentation is for educational and informational purposes only. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. This video is not financial advice, and I am not a financial advisor. Past performance is not indicative of future results. All strategies and case studies are shown for illustrative purposes. $5.3 trillion. That's not a typo. Over $5 trillion are traded on the foreign exchange market every single day. To put that in perspective, that's more than the New York Stock Exchange, the Tokyo Stock Exchange, and the London Stock Exchange combined. It is the single largest, most liquid financial market on the entire planet. And yet, for most people, it feels like a secret club. A high-stakes game played by Wall Street wizards in glass towers, speaking a language you were never meant to understand. You've seen the confusing charts, the flashing red and green numbers, the jargon like pips, leverage, and lots. It feels intentionally complicated, designed to keep the average American out. Well, that ends today. Right here. Right now. This isn't just another trading video. This is the first step in a complete 10-part masterclass designed from the ground up, specifically for you, the American beginner in 2026. My goal for this series is simple: to pull back the curtain and demystify the world of Forex. We are going to dismantle it piece by piece and rebuild your understanding on a foundation of solid no-hype principles. By the end of this course, you won't just know what the jargon means. You will have a clear, actionable framework for how to approach these markets with intelligence and a plan. We're going to turn confusion into confidence. First, let's shatter the myths that have probably been holding you back. Myth number 1. You need to be a math genius or have a finance degree from an Ivy League school. This is the biggest lie in the industry. Successful trading is far less about complex calculus and far more about psychology, discipline, and risk management. It's about recognizing patterns and sticking to a plan, not about predicting the future with a crystal ball. Can you follow a set of rules like a pilot following a pre-flight checklist? If you can, you have the core mental skill required. Myth number 2. Forex is just gambling. It's no different than going to Las Vegas and putting it all on black. This is a fundamental misunderstanding of what we're doing here. Gambling is betting on an outcome with no real edge, a game of pure chance where the house always wins in the long run. Strategic trading, on the other hand, is about analyzing probabilities. It's about looking at historical data, understanding economic drivers, and placing calculated trades where the potential for a positive outcome outweighs the risk. We don't guess. We analyze, we strategize, and most importantly, we manage our risk on every single trade. A gambler hopes, a trader plans. And the biggest myth of all, number 3. You need a massive $50,000 account to even get started. Maybe that was true 20 years ago, but technology has changed the game. Today, thanks to reputable US-regulated brokers, you can open an account with a surprisingly small amount of capital. We're not talking about your life savings. We're talking about starting small, learning the ropes with minimal risk, and proving your strategy before ever thinking about scaling up. The barrier to entry has never been lower. So, why should you, an American living your daily life, even care about the exchange rate between the euro and the Japanese yen? Because the Forex market is the circulatory system of the global economy. It's the ultimate macro playing field. Every time you hear on the news that the Federal Reserve is raising interest rates to fight inflation, that directly impacts the value of the US dollar. Every time there's a major jobs report, an election, or a global supply chain disruption, the shockwaves are felt instantly in the currency markets. This isn't some abstract concept. It's the real-time financial pulse of the world. And because it's a global market, it runs 24 hours a day, 5 days a week. It doesn't matter if you work a 9 to 5, a night shift, or you're a stay-at-home parent. The market is open and moving, providing opportunities that fit your schedule, not the other way around. Now let's get to the core question. What actually is Forex trading? Let's forget the charts and the jargon for a second and use a simple analogy. Imagine you're at JFK Airport in New York, getting ready to fly to London. You walk up to a currency exchange kiosk and you trade 1,000 US dollars for British pounds. Let's say the exchange rate gets you 800 pounds. You go on your trip, have a great time, but you don't spend all your money. A week later, you fly back to JFK with that same 800 pounds. You go back to the kiosk to change it back to dollars. But in that week, the exchange rate has changed. The British pound has gotten stronger against the US dollar. So now, when you exchange your 800 pounds, you don't get $1,000 back. You get $1,050 back. You just made 50 bucks simply because the value of one currency changed relative to another. Congratulations! You have just conducted a Forex trade. Now imagine doing that from your laptop or your phone. Instead of physically exchanging cash, you're doing it digitally. Instead of waiting a week, the rates are changing every single second. And instead of just trading the dollar and the pound, you have access to dozens of currency pairs from all over the world. That, in a nutshell, is the foreign exchange market. We are speculating on the direction one currency will move against another. If we think the euro is going to get stronger against the US dollar, we buy the euro to US dollar pair. If we think it's going to get weaker, we sell it. It's that conceptually simple. The complexity comes in learning how to make educated decisions about which direction that might be. And it's not just people like us in the market. You have the major players, the whales. Huge international banks like JP Morgan Chase and Goldman Sachs, trading massive volumes that move the entire market. You have multinational corporations. Think about Apple. They sell iPhones in the US for dollars, but they buy components from China using the yuan and from South Korea using the won. They have to constantly exchange currencies to run their business, and they do it in the Forex market. You have governments and central banks like our own Federal Reserve, who intervene in the markets to stabilize their own currency. And then you have us, the retail traders. We're the smallest fish in this gigantic ocean, but because of modern technology and brokerage platforms, we get to swim right alongside the sharks, analyzing the same price movements and participating in the same global economic shifts. This is the start of your journey, and I want to be very clear about the path we're going to take together. This 10-part course is a roadmap. We are starting here at ground zero with the absolute basics. In the next part, we're going to learn the language. We'll define what a pip is, what a lot is, and we will finally explain the double-edged sort of leverage in a way that actually makes sense. From there, we'll cover how to choose a safe, US-regulated broker, because your security is non-negotiable. Then we'll dive into the charts, learning how to read candlesticks and identify trends. We will cover fundamental analysis, how economic news moves markets, and technical analysis, using historical price action to inform future possibilities. We will build a sample trading plan from scratch, focusing heavily on the most critical component, risk management. We will cover trading psychology, the art of controlling your emotions when real money is on the line. Each part builds directly on the last. We're building your knowledge brick by brick, creating a solid structure that won't collapse when the market gets volatile. My commitment to you is to deliver this entire course with zero fluff and zero hype. There are no secret indicators or magic formulas here. This is about process, discipline, and education. This is your chance to learn a skill that can serve you for a lifetime, giving you a profound understanding of how the global economy truly works. So get ready. The most important journey starts with a single step, and you've just taken it. And that first step is understanding what this market actually is. Forget the intimidating charts and the blinking numbers for a moment. Let's bring this down to earth. You've probably already participated in the Forex market without even knowing it. Imagine you're planning a trip to Italy. You walk into your local bank here in the US and you hand the teller $1,000. In return, they give you, let's say, 930 euros. What just happened? You exchanged one currency for another. You sold dollars and bought euros. That transaction right there is the foreign exchange market in its purest form. Now scale that up. Instead of you, a tourist, exchanging $1,000, imagine a multinational corporation like Apple. They've just sold millions of iPhones in Europe and now have a mountain of euros sitting in a bank account. But Apple is an American company. They need to pay their US-based engineers, pay their US taxes, and report their profits in US dollars. So, they go into the market and exchange those hundreds of millions of euros back into US dollars. That single transaction can influence the value of the euro versus the dollar for a brief moment. Now imagine that happening millions of times a day, every single day, with every major corporation, every international bank, every government, and every traveler on the planet. That is the Forex market. It's not a stock market where you buy a piece of a company. It's the global marketplace for all the world's currencies. It is the literal circulatory system of the global economy, with over $7 trillion flowing through it every single day. That number is so vast it's hard to comprehend. It's more than every stock market in the world combined. This isn't some niche market. It is the market. And because of its sheer size, it's also the most liquid financial market in the world, meaning it's incredibly easy to get in and out of trades, something that's a huge advantage. So, how do we make sense of it all? We start with the language. In Forex, you don't trade one thing in isolation. You're always comparing one currency to another. This is why they are always quoted in pairs. You've likely seen this before. Euro to US dollar. Let's break that down. Simpler than it looks. The first currency, in this case the euro, is called the base currency. The second one, the US dollar or USD, is the quote currency. Here's the easiest way to think about it. The base currency is the product you're buying or selling. It always represents 1 unit, 1 euro. The quote currency is the price. It tells you how much of the quote currency it costs to buy 1 unit of the base currency. So, if you see euro to US dollar equals 1.0800, it literally means that 1 euro costs $1.08. That's it. That's the entire concept. If you believe the euro is going to get stronger compared to the dollar, you would buy the euro to US dollar pair. If you believe the euro is going to get weaker, and the dollar will get stronger, you would sell the pair. You're always making a judgment on the relative strength of two economies. Now there are dozens of currency pairs you can trade, but as a beginner, you want to focus on what are known as the majors. The major pairs are the most traded pairs in the world, and they all have one thing in common. They all include the US dollar. The US dollar is the world's reserve currency, meaning it's involved in nearly 90% of all Forex transactions. The majors are pairs like our example, euro to US dollar, which pits the Eurozone against the US. There's US dollar to Japanese yen, the US dollar versus the Japanese yen. There's pound sterling to US dollar, the British pound versus the US dollar, often called the cable, and a few others like the US dollar versus the Canadian dollar, the Australian dollar, and the Swiss franc. Why do we focus on these? Because they represent the largest and most stable economies. This means they typically have the highest trading volume, which leads to tighter spreads. That's the small fee you pay to your broker, and more predictable movements based on economic data. There are also minor pairs, which don't involve the US dollar but include other major currencies like the euro, yen, or pound. And then there are exotics, which pair a major currency with one from a smaller or emerging economy. For now, just know they exist. Our focus, our entire foundation will be built on understanding the majors. So we know what the market is and we know its basic language. The next critical question is, who are the players? When you place a trade, who is on the other side? Understanding this is key to grasping why the market moves. At the very top of the food chain are the big banks, think JP Morgan, Deutsche Bank, Citibank. This is the interbank market. They aren't just trading for themselves, they are facilitating massive trades for their clients, the huge multinational corporations we talked about. They are the whales in this ocean, and their volume dictates the flow of the market. Right alongside them are the world's central banks like our own Federal Reserve, the European Central Bank, or the Bank of Japan. Their job isn't to make a profit. Their job is to manage their country's economy. They control interest rates, fight inflation, and work to stabilize their currency. When the chairman of the Federal Reserve even hints at changing interest rates, it sends shockwaves through the Forex market, causing massive, immediate movements. Their announcements are scheduled, and learning to navigate them is a skill we will cover in depth later. Then you have the large commercial companies, the investment managers, the hedge funds. They trade for a variety of reasons, to protect themselves from currency fluctuations in their international business, or as a core part of their investment strategy, speculating on where currencies are headed. And finally, there's us, the retail traders. We are the smallest piece of the puzzle, but we are the fastest growing segment. Through online brokers, we get access to the same marketplace as these giants. But it's vital to maintain perspective. We are not moving the market. We are small fish navigating an ocean where the currents are created by the movements of those giant whales. Our job isn't to fight the current. It's to learn to read it, respect it, and ride it. This leads to one of the most unique and appealing features of the Forex market. It never sleeps. Because it's a global market, trading follows the sun around the world. It's a 24-hour-a-day, 5-day-a-week market. The day begins with the Sydney session opening, followed a few hours later by Tokyo. As Asia is winding down, the London session, the largest and most important financial center, opens up. And a few hours after that, New York comes online. For a few hours every day, the two biggest centers, London and New York, are open at the same time. This overlap is typically when the market sees the highest volume and the biggest moves, offering a period of heightened activity. What does this mean for you? It means unparalleled flexibility. It doesn't matter if you work a 9-to-5 job, a night shift, or have a chaotic schedule. There is always a session open. You can trade early in the morning before work during the end of the London session, or in the evening during the Asian session. This isn't like the stock market, which is confined to specific exchange hours. The Forex market adapts to your life, not the other way around. So let's recap what we've established. The Forex market isn't some abstract concept. It's the tangible exchange of currencies that powers our world, and you've likely already been a part of it. We learned its language is based on currency pairs, comparing the value of one country's economy to another, and that our initial focus will be on the major pairs involving the US dollar. We've identified the key players, from the giant banks that create the currents to us retail traders who learn to navigate them. And we've seen that this market operates 24 hours a day, offering a level of flexibility no other market can match. You now have the foundational map of this world. You understand the terrain, who lives here, and the rhythm of its days. But a map is useless if you can't read the symbols on it. You need to be able to see the story the market is telling you moment by moment. In the next part, we're going to pull back the curtain on the single most important tool a trader has, the chart. We'll learn to read those red and green bars, called candlesticks, not as random patterns, but as the footprints of the market giants. Each one tells a story of a battle between buyers and sellers, a story of greed, fear, and opportunity. This is where the theory ends, and the practical skill of reading the market's true language begins. And that language is written in candles, Japanese candlesticks. Each one is a snapshot, a single frame in the epic movie of the market, capturing the raw emotion and the power struggle between buyers and sellers over a specific period of time, whether it's 1 minute, 1 hour, or 1 day. To the untrained eye, it's just a chart of red and green bars. But to a trader, it's a living, breathing story. Our job is to learn how to read it. Let's start with the anatomy of a single candlestick. Think of it as a 4-part story. It tells you 4 crucial pieces of information: the opening price, the closing price, the highest price, and the lowest price within that time frame. We call this OHLC, open, high, low, close. The thick, rectangular part is called the body. This is the heart of the story. Tells you where the price opened and where it closed. If the body is green or sometimes white, it means the closing price was higher than the opening price. This is a bullish candle. Buyers were in control during this period. They won the battle. They took the price from the bottom of the body and pushed it all the way to the top. Conversely, if the body is red or sometimes black, it means the closing price was lower than the opening price. This is a bearish candle. Sellers were in control. They grabbed the price at the top of the body and slammed it down to the bottom. The color and size of the body instantly give you a feel for the market sentiment in that moment. A long green body screams buying pressure. A long red body shouts selling pressure. Now look at the thin lines that often stick out from the top and bottom of the body. These are called wicks or shadows. The wicks tell you the rest of the story, the full range of the battle. The very top of the upper wick shows the highest price reached during that period. It's the point where sellers stepped in and said, "Not so fast," pushing the price back down. The very bottom of the lower wick shows the lowest price reached. This is where buyers drew a line in the sand and said, "No further," pushing the price back up. So let's piece it together. Imagine a long green candle with a small wick on top. The story goes like this. The session opened. Buyers immediately took charge, pushing the price upward. Sellers tried to fight back a little bit at the peak, creating that small upper wick, but the buyers were too strong and ultimately closed the session near the high, firmly in control. It was a decisive victory for the bulls. Now picture a red candle with a long lower wick. What's that story? The session opened and sellers took control, driving the price down, down, down. But at the lowest point, a wave of buyers flooded in. They fought back hard, pushing the price all the way back up from the lows, but they didn't have enough strength to turn the session positive. The sellers still won, closing the price lower than it opened, but the long lower wick tells us the buyers are waking up. It's a sign of a potential shift in momentum. Every single candle tells a story like this. But when you start putting them together, you move from reading single letters to reading words and sentences. These are called candlestick patterns, and they are the foundation of what we call price action analysis. We're not going to cover dozens of obscure patterns. Instead, we'll focus on a few of the most common and historically significant ones that appear time and time again across all markets. Let's start with the ultimate symbol of indecision, the doji. A doji is a candle with a very small, almost non-existent body. This means the opening price and the closing price were virtually the same. It can have long upper and lower wicks, looking like a cross or a plus sign. What is this candle telling you? It's telling you that for the entire period, buyers and sellers fought to a complete standstill. Neither side could gain control. A doji signals a pause, a moment of reflection in the market. If you see a doji after a long, powerful trend, it can be a potential early warning that the trend is running out of steam. It's the market taking a breath. And you should pay close attention to what happens next. The exact opposite of a doji is the marubozu. This is the candle of pure conviction. A marubozu is a long-bodied candle with no wicks at all. A green marubozu means the buyers were in absolute control from the very start to the very end. The price opened at the low and closed at the high. There was no hesitation. A red marubozu is the same story but for the sellers. They controlled the price from the open at the high to the close at the low, without any fight from the buyers. When you see a marubozu, you are seeing a market with a one-track mind. Now let's look at two critical patterns that can signal a potential reversal. The hammer and the hanging man. They look identical, but their meaning depends entirely on where you find them. Both have a small body at the top and a long lower wick that is at least twice the length of the body, with little to no upper wick. Imagine a currency pair has been in a strong downtrend, with lots of red candles. Suddenly a hammer appears. This candle tells us that sellers tried to push the price down again, creating that long lower wick. But then, a surge of buying pressure came in, rejecting those lower prices and pushing the price all the way back up to close near the open. The sellers tried to land another blow, but the buyers caught their fist. A hammer after a downtrend is a bullish reversal signal. It suggests the bottom might be near. Now, take that exact same candle shape and place it at the top of a strong uptrend. This is called a hanging man. The story is different now. The market has been climbing, but in this session, sellers managed to push the price significantly lower before buyers stepped back in to bring it back up near the open. Even though the candle might be green, that long lower wick shows that for the first time in a while, a significant amount of selling pressure appeared. It's a potential warning sign that the buying momentum is weakening, and the trend could be about to reverse. Finally, let's talk about one of the most powerful two-candle patterns, the engulfing pattern. As the name suggests, this pattern involves one candle completely engulfing the previous one. A bullish engulfing pattern happens at the end of a downtrend. You'll see a small red candle, followed by a large green candle whose body completely covers or engulfs the body of the previous red candle. The story here is a dramatic shift in power. The market was in a selling mood in the first period. But in the next period, the buyers came in with such overwhelming force that they not only erased all of the previous period's losses, but also pushed the price significantly higher. It's a clear statement that the buyers are now in control. The bearish engulfing pattern is the mirror image and occurs at the top of an uptrend. You'll see a small green candle, followed by a massive red candle that engulfs it. It shows that the buyers were happily pushing the price up, but then the sellers stepped in with overwhelming force, completely reversing the previous period's gains and then some. It's a powerful signal that the sellers have taken over, and the uptrend may be over. Now, this is the most important part of this entire lesson. You cannot look at these patterns in a vacuum. A hammer in the middle of a choppy, sideways market means very little. A bullish engulfing pattern that isn't at the bottom of a clear downtrend is just noise. Context is everything. These patterns gain their significance from where they appear on the chart. Think of them as signals, not as guarantees. They are clues that suggest a potential outcome, not a crystal ball that predicts the future. The best practice for a developing trader is to always look for confirmation. If you see a hammer at the end of a downtrend, don't just assume the market is going up. Wait and see what the next candle does. If the next candle is a strong green candle that closes above the high of the hammer, that's your confirmation. That tells you that other market participants saw the same signal and are acting on it. This patience, this discipline to wait for confirmation, is a critical habit that separates disciplined traders from gamblers. It's a key component of managing risk. So you now have the alphabet of the market. You can read the words of indecision, of conviction, of potential reversal. But a word out of context is just noise. To understand the story, you need to know where these words are being spoken. You need to identify the battlegrounds, the key levels on the chart where the biggest fights between buyers and sellers are most likely to happen. And that is the art of identifying support and resistance. Think of the chart not as a random series of squiggly lines, but as a map of a battlefield. Support and resistance levels are the key fortresses, trenches, and high ground positions on that map. They are the price points where the balance of power between buyers and sellers has historically shifted. Let's start with support. Imagine a trampoline. When an object falls onto it, it doesn't just crash through the floor. It hits the trampoline, the downward momentum stops, and it bounces back up. Support is the market's trampoline. It's a price level where falling prices tend to stop and reverse, heading back up. Why? Because at this level, the buyers, the bulls, decide to make a stand. They see the price as a bargain. They believe that at this specific price, the currency pair is undervalued, so they start buying in droves. This surge in demand overwhelms the selling pressure, and just like that, the price bounces. On your chart, you can spot potential support levels by looking for areas where the price has dropped to, and then bounced up from the same level multiple times in the past. Think of it as the market having a memory. If the euro to US dollar fell to 1.0500 and then rallied strongly, the next time it approaches 1.0500, a lot of traders will be thinking, hey, this was a great buying level last time, maybe it will be again. This becomes a self-fulfilling prophecy. The more times a price level acts as a trampoline, the stronger that support level is considered to be. It's like a fortress wall that has withstood multiple attacks. Now let's flip the script and talk about resistance. If support is the trampoline on the floor, resistance is the solid steel ceiling. It's a price level where rising prices tend to stop and reverse, heading back down. This is where the sellers, the bears, make their stand. They look at the price and think, this is getting too expensive. It's overvalued. It's time to sell and take profits. This flood of selling supply overwhelms the buying demand, and the price gets pushed back down, as if it just hit its head on the ceiling. You identify resistance on a chart the same way you find support, but in reverse. You look for price peaks where the market rallied to a certain level, and then sold off multiple times. Each time the price hits that ceiling and is rejected, it reinforces that level in the market's memory. Traders see that ceiling and think, last time we got to this price, a huge wave of selling came in. I should be careful. Again, the more times a resistance level holds, the stronger that bear fortress is perceived to be. So you have the bulls defending their floor, and the bears defending their ceiling. Price is often bouncing between these two levels, like a tennis ball in a hallway. This area between a clear support and resistance level is called a range or a channel, and it's where much of the day-to-day battle takes place. But here is where it gets truly fascinating. This is the single most important concept about support and resistance that you need to understand. What happens when a fortress is finally breached? Imagine the bulls, the buyers, are so powerful, so full of conviction, that they don't just rally up to the resistance ceiling, they smash right through it. That ceiling is now broken. What happens next is a psychological masterpiece. That old ceiling, that former line of defense for the sellers, now becomes the new floor for the buyers. The old resistance becomes new support. Why? Think about the psychology. The traders who were selling at that resistance level are now kicking themselves. They sold too early. They're thinking, if the price ever comes back down to that level I sold at, I'm buying back in. At the same time, the buyers who broke through are feeling confident. They see the price dipping back to their breakout point and think, this is our new line in the sand. We conquered this territory, and we're going to defend it. So, a level that was once a source of selling pressure magically transforms into a source of buying pressure. An old enemy becomes a new ally. This role reversal principle is a cornerstone of technical analysis. The same thing happens in reverse. If the sellers, the bears, push the price down with so much force that it breaks through a support floor, that old floor will often become the new ceiling. The old support becomes new resistance. The buyers who were defending that level are now in losing positions. Their psychology shifts from hope to despair. They're just praying for the price to rally back up to the level they bought at so they can sell and get out with a smaller loss. This creates a wall of sellers at the old support level, preventing the price from easily climbing back up. So, when you draw these lines on your chart, you're not just drawing lines. You are mapping out the psychological battle lines of the market. You're identifying the key areas where control is likely to be fought for, and potentially change hands. Now, these battle lines aren't always perfect, flat, horizontal lines. They can take a few different forms. The first, as we've discussed, are the classic horizontal support and resistance lines. They are the easiest to spot and represent clear, specific price points. The second type is dynamic support and resistance, often represented by trend lines. Imagine a market that is consistently making higher highs and higher lows, an uptrend. If you draw a line connecting the lows, you'll often see the price come down, touch that ascending line and bounce off it, continuing its upward journey. That rising line is acting as a dynamic support. It's not a fixed price, but a moving zone of support that travels up with the trend. The opposite is true in a downtrend. A line connecting the series of lower highs will often act as a dynamic resistance, a moving ceiling that the price struggles to break above. And there's a third, more subtle type: psychological levels. Human beings are simple creatures. We love round numbers. Prices like 1.2000 on the pound sterling to US dollar, or 150.00 on the US dollar to Japanese yen, are significant psychological milestones. Large banks, hedge funds, and individual traders often place a large number of orders around these big, round numbers. Because of this, these levels can act as invisible support or resistance without any prior price action needing to be there. The market just naturally hesitates and reacts at these clean, memorable numbers. So let's put this all together. You open your chart. You zoom out to get the big picture. You start looking for the obvious turning points. You see a few major bottoms that line up around the same price. You draw a horizontal line. That's your support fortress. You see several peaks that were rejected at the same level. You draw another horizontal line. That's your resistance fortress. You notice the price is in a clear uptrend, bouncing off an invisible rising floor. You draw a diagonal trend line. That's your dynamic support. Suddenly, your chart is no longer a chaotic mess. It's a strategic map. You have defined the battlefield. You know where the bulls have their defenses and where the bears have their strongholds. You can see the territory they are fighting over. This gives you context for every single price movement. But this raises the most important question of all. We can draw the lines. We can identify the fortresses. But how do we know if the fortress is about to hold, or if it's about to crumble? How do you spot the signs of a crack in the wall before the whole thing comes crashing down? Just drawing lines isn't enough. You need to be able to interpret the action happening at these critical levels. You need to listen to the story the price is telling you moment by moment as it approaches a key battleground. And that story, that secret language of the market, is told through candlestick patterns. That's where we learn to read the real-time ebb and flow of the fight between buyers and sellers, and that is precisely what we are diving into next. Think of each candlestick as a miniature story, a snapshot of a single round in the epic fight between buyers and sellers. On its own, one candle tells you a little. Strung together, they form the narrative of the market, revealing its fears, its greed, and its moments of pure indecision. To read this story, you first need to understand the anatomy of the storyteller itself. The candle. Every single candlestick, no matter the time frame, tells you four crucial pieces of information: the open, the high, the low, and the close. We call this OHLC. Imagine a trading session, whether it's 1 minute or 1 day. The price where it started is the open. The absolute highest point it reached during that time is the high. The absolute lowest point it touched is the low. And the price where it finished is the close. These four data points create the shape we see. The thick part of the candle is called the body. This body shows you the distance between the opening price and the closing price. If the close is higher than the open, it's typically colored green or white. This is a bullish candle. It means the buyers won that round. They pushed the price up from where it started. The bigger the green body, the more decisive the victory for the buyers. Conversely, if the close is lower than the open, the candle is usually colored red or black. This is a bearish candle. The sellers won. They dragged the price down from its opening level. The bigger the red body, the more ground the sellers took in that battle. Then you have the thin line sticking out from the top and bottom of the body. These are called wicks or shadows. The wicks tell the story of the struggle. The top of the upper wick is the high of the session, and the bottom of the lower wick is the low. Long wicks tell us there was a fierce back and forth. For example, a long upper wick on a red candle tells a fascinating story. The buyers tried to push the price way up, but the sellers fought back with incredible force, not only stopping the advance but pushing the price all the way back down to close below where it even started. It's a story of a failed assault and a powerful counterattack. Understanding this basic anatomy is the foundation. Now let's learn the alphabet. These are the single candle patterns that act as critical signals of market sentiment. The first and most decisive is the Marubozu. This is a candle with a full body and no wicks at all. A green Marubozu means buyers were in complete control from the open to the close. They opened at the low and closed at the high. It's a statement of pure, unadulterated bullish strength. A red Marubozu is the opposite, pure bearish dominance. Sellers controlled the session from start to finish. It's the market equivalent of a knockout punch. But what happens when the fight is a draw? That's where we get one of the most important candles of all. The doji. A doji is a candle with a very small body or no body at all. It looks like a cross or a plus sign. This happens when the open and close price are almost exactly the same. The doji is the ultimate signal of indecision. The bulls and bears fought to a complete standstill. Neither side could gain control. When you see a doji after a long trend, it's a potential warning sign. It's the market pausing to catch its breath, questioning its direction. A long-running general who suddenly hesitates is a general whose army starts to doubt the mission. Now let's look at two patterns that signal a potential reversal at the bottom of a trend. The first is the hammer. A hammer has a long lower wick and a small body at the top. It looks like its name. The story it tells is powerful. During the session, the sellers pushed the price way down. But then the buyers staged a heroic comeback, pushing the price all the way back up to close near the open. The sellers tried to land a finishing blow, but they were rejected. This rejection of lower prices is what makes the hammer a potential bullish reversal signal. It's the market hammering out a bottom. Its cousin at the top of a trend is called the hanging man. It looks identical to a hammer. Small body at the top, long lower wick, but its location changes its meaning entirely. When this shape appears after a strong uptrend, it suggests that sellers are starting to test the buyer's resolve. Significant selling occurred during the session, even though buyers managed to push it back up by the close. It's a sign of weakness, a crack in the bullish armor. The mirror images of these are the inverted hammer and the shooting star. The inverted hammer appears at a bottom and looks like an upside-down hammer. Small body at the bottom, long upper wick. It shows that buyers tried to rally, but sellers pushed them back down. While it sounds bearish in the context of a downtrend, it can be seen as the first brave attempt by buyers to step in. The shooting star, however, is its more formidable bearish twin. It appears at the top of an uptrend. A long upper wick and a small body at the bottom. The story? Buyers tried to continue their triumphant march higher, but they ran into a wall of sellers who brutally rejected their advance, sending the price plummeting back down. It looks like a star falling from the heavens, and it often signals that the bullish party might be over. Now that we have our letters, let's start forming words with 2 and 3 candle patterns. The most powerful 2-candle pattern is the engulfing pattern. A bearish engulfing pattern occurs at the top of an uptrend. You have a green candle, followed by a larger red candle, whose body completely engulfs the body of the previous green candle. This is a dramatic power shift. It's like the sellers not only stopped the buyer's advance, but in the very next session, they launched a counteroffensive that completely wiped out all the previous session's gains and then some. It's a clear and aggressive signal that the bears are taking control. The bullish engulfing is the exact opposite at the bottom of a downtrend. A red candle is followed by a massive green candle that completely engulfs it. It's a sign that buyers have stepped in with overwhelming force, signaling a potential reversal to the upside. Next is the harami pattern. Harami is the old Japanese word for pregnant. This pattern is a large candle followed by a much smaller candle that is contained within the body of the first one. A bearish harami is a large green candle followed by a small red candle. It signifies that the bullish momentum is fading. The market's powerful stride has been reduced to a hesitant little step. It's a sign of indecision and a potential top. The bullish harami is a large red candle followed by a small green candle at a bottom, signaling the sellers might be running out of steam. Finally, let's look at a classic 3-candle pattern: the morning star and the evening star. The morning star is a beacon of hope for bulls at the bottom of a downtrend. It consists of 3 candles. First, a long red candle continuing the downtrend. Second, a small-bodied candle or a doji that gaps down, representing the moment of maximum pessimism and indecision. And third, a strong green candle that pushes back up, closing well into the body of the first red candle. This 3-act play shows the sellers in control, then a moment of equilibrium, and finally a decisive takeover by the buyers. The evening star is its ominous counterpart at the top of an uptrend. A long green candle followed by a small-bodied candle or doji that gaps up, and then a third strong red candle that falls sharply. It's the story of a trend hitting its peak, hesitating, and then reversing with conviction. Now, here is the single most important rule you must never forget. Candlestick patterns are not a crystal ball. They are indicators of market psychology, not guarantees of future performance. A hammer doesn't mean the price will go up. It means the market is showing you evidence of buying pressure at a lower level. Its predictive value increases exponentially with one thing: context. Context is everything. A bullish engulfing pattern in the middle of a choppy, sideways market means very little. But a bullish engulfing pattern that appears right at a major, historically tested support level after a long downtrend? That is a signal you pay very close attention to. A shooting star pattern on low volume is interesting. A shooting star on a massive spike in volume at an all-time high? That's a 5-alarm fire for the bulls. Think of it this way. Learning these patterns is like learning the vocabulary of the market's language. But to truly understand the story, you need grammar and syntax. You need to know where in the sentence the word appeared. That grammar is provided by the market structure itself, the trends, the channels, and most importantly, the key levels of support and resistance where these battles for control are won and lost. Learning to identify those battlegrounds is the next critical step in our journey. Think of the financial market not as a random series of numbers, but as a map of human psychology. And on this map, support and resistance levels are the key fortresses, the major cities, the critical mountain passes where battles for control are repeatedly fought. These aren't just arbitrary lines on a chart. They are a visual representation of supply and demand, of fear and greed, of memory. Let's break this down with a simple analogy. Imagine you're in a room with a floor and a ceiling. You drop a bouncy ball. It hits the floor and bounces back up. The floor acted as a support, preventing it from falling further. Then it flies up and hits the ceiling, which rejects it and sends it back down. The ceiling acted as resistance, preventing it from going higher. In Forex trading, support is a price level where a downtrend can be expected to pause due to a concentration of demand. Think of it as the floor. As the price of a currency pair drops, it becomes cheaper, more attractive to buyers. When it reaches a certain level, a level where it has previously bounced, a flood of buyers may enter the market, believing it's a bargain. This surge in buying interest or demand overwhelms the selling pressure, and the price bounces back up. That price level is now confirmed as a support zone. Resistance is the opposite. It's the ceiling. It's a price level where an uptrend can be expected to pause or reverse due to a concentration of supply. As a currency pair rallies, it becomes more expensive. Eventually, it reaches a price that sellers believe is a great place to take profits, or that short sellers believe is overvalued. At this level, often a place where the price has been rejected before, a wave of selling pressure hits the market. This supply of the currency overwhelms the buying demand, and the price is pushed back down. That level becomes a resistance zone. But why does this happen? It's not magic. It's market psychology and memory. Let's say the euro against the US dollar, the euro to US dollar, struggles to break above the 1.0900 level multiple times. Traders remember this. Those who bought lower will see 1.0900 as a logical place to sell and take their profits. Those who want to bet against the euro will see 1.0900 as a low-risk point to enter a sell order, because historical trends suggest it will fall from there. This collective action, based on the memory of that price level, creates the very resistance it's anticipating. The same logic applies to support. If euro to US dollar has bounced up from 1.0750 times in the past month, buyers will be waiting there, ready to pounce, reinforcing it as a strong floor. So, how do we find these critical levels on our charts? We start by looking at the past. We are essentially market historians, looking for the most obvious turning points. To find support, scan your chart from right to left, looking for significant swing lows. These are the bottoms of the V-shapes where price stopped falling and started rising. Mark the lowest point of that swing with a horizontal line. If you see multiple swing lows all clustering around the same price area, that's a powerful sign. The more times price has tested a level and bounced off it, the more significant that support level is considered to be. It's a battle-tested fortress that has held against multiple attacks from the sellers. To find resistance, you do the exact same thing but in reverse. You look for significant swing highs, the peaks of the U-shapes where price stopped rising and started falling. You mark that high point with a horizontal line. Again, if you find multiple peaks forming at or near the same price, you've likely identified a major resistance zone. This is a ceiling that has proven difficult for the buyers to break through. Now, here is a concept that, once you understand it, will fundamentally change how you view the market. It's called role reversal. What happens when one of these fortresses finally falls? What happens when an unstoppable force of buyers finally breaks through a long-standing resistance ceiling? That ceiling, that level that was once a barrier, now becomes the new floor. Old resistance becomes new support. Think about it. A massive amount of buying pressure was needed to break that level. When the price eventually comes back down to retest it, two things happen. First, the buyers who missed the initial breakout see this as their second chance to get in at a good price. Second, the sellers who were short and are now losing money might use this retest to buy back their positions and cut their losses, which is also a buy order. This combined buying pressure at the old resistance level turns it into a powerful new support level. The same is true in reverse. When a critical support floor is broken by overwhelming selling pressure, it often becomes the new ceiling. Old support becomes new resistance. Buyers who bought at that support level are now trapped in a losing position. Their hope is for the price to rally back up to their entry point so they can sell and get out at break-even. This desire to sell at the old support level creates a wall of supply, turning that broken floor into a new formidable ceiling. This principle of role reversal is one of the most reliable phenomena you will see on a price chart, and it provides a framework for understanding the ongoing market narrative. But here's where many beginners make a critical mistake. They draw dozens of lines all over their chart, creating a confusing mess that looks like a spiderweb. And they treat these lines as exact perfect price points. The market is not that precise. You must think of support and resistance not as thin, brittle lines, but as thick, flexible zones. Price might poke through a support level by a few pips before reversing. It might stop just short of a resistance level before falling. That's why we call them support and resistance zones or areas. It's a region on the chart where a reaction is likely, not a specific price down to the last decimal. Another common pitfall is ignoring the context of time frames. A support level identified on a 15-minute chart is a small hill. A support level that is visible on the daily or weekly chart is a mountain range. The higher the time frame a support or resistance level is identified on, the more significant it is. Why? Because it represents a consensus of value over a much longer period, involving far more capital and participants. A weekly level has been tested and held over weeks and months, reflecting the collective decisions of long-term investors, banks, and institutions. Always start your analysis on a higher time frame, like the daily chart, to identify the major battlegrounds, the mountain ranges, before zooming into lower time frames to see the smaller skirmishes. So, to recap, support and resistance levels are the foundation of market structure. They are zones, not lines, that represent the psychological memory of the market, where the balance of supply and demand has previously shifted. We identify them by looking for historical swing highs and swing lows. And we pay close attention when one is broken, because it will often reverse its role, with old support becoming new resistance, and old resistance becoming new support. By learning to map these key levels, you are no longer just looking at a squiggly line. You are reading the story of the market. You are identifying the strategic locations where the big moves are likely to originate. You're seeing the defensive lines drawn by sellers and the staging areas for buyers. But identifying these zones is only half the battle. A price arriving at a major support level doesn't automatically mean you should buy. It's like arriving at the scene of a potential battle. You need to look for clues. You need to analyze the behavior of the armies themselves. How do we see if the buyers are actually showing up in force? How do we know if the seller's defense is starting to crumble? The answer lies in the price action itself, specifically in the language of Japanese candlesticks, which we will decipher in our next part. These individual candles tell the story of the battle for each session, and learning to read them at these key levels is what separates the novice from the developing trader. Each candle is a snapshot, a single frame in the epic movie of the market, and at the heart of each candle are four crucial pieces of information: the open, the high, the low, and the close for that specific time period, whether it's a 1-minute chart or a 1-day chart. Let's break it down. The main, thick part of the candle is called the body. This body tells you the story of the session's primary conflict. It represents the distance between the opening price and the closing price. If the candle is green or sometimes white, it means the closing price was higher than the opening price. The buyers won that session. We call this a bullish candle. If the candle is red or sometimes black, it means the closing price was lower than the opening price. The sellers won. This is a bearish candle. The size of the body matters. A long body shows strength and conviction from the winning side. A short body shows very little price movement, a sign of indecision or a quiet period. Then you have the thin line sticking out from the top and bottom of the body. These are called wicks or shadows. The wicks tell you the full story of the battle, the extremes. The very top of the upper wick shows the highest price the market reached during that session. The very bottom of the lower wick shows the lowest price. Think of these as the territory that was fought over, but not held. A long upper wick on a candle tells you that buyers tried to push the price much higher, but sellers fought back and forced the price down before the session closed. It's a story of a failed rally. A long lower wick tells the opposite story. Sellers tried to drag the price way down, but buyers stepped in with force, defended their ground, and pushed the price back up. It's a story of a failed sell-off. By combining the body and the wicks, you're no longer just looking at a chart. You're reading a story of pressure, momentum, and psychology. Let's start with the most basic, yet most powerful candles. First, the Maribozu. This is a Japanese word meaning bald head, and that's exactly what it is. A candle with a long body and no wicks at all. A green Maribozu means buyers were in complete control from the moment the session opened to the moment it closed. The open was the low of the session, and the close was the high. It's a pure signal of bullish strength. A red Maribozu is the opposite, pure bearish dominance. Sellers controlled the price from open to close. When you see one of these, the market isn't whispering. It's shouting its intention. Now, for the polar opposite of the Maribozu, the doji. A doji is a candle of pure indecision. It happens when the opening and closing prices are virtually the same, so the body is just a tiny sliver or a horizontal line. It looks like a plus sign or a cross. It signifies a perfect stalemate, a tug of war where neither buyers nor sellers could gain any ground. While a Maribozu screams conviction, a doji whispers uncertainty. After a long trend, a doji can be a powerful warning sign that the momentum is fading, and a reversal could be on the horizon. Now let's get into the patterns that tell more complex stories. Meet the hammer and the hanging man. They look identical, but their meaning is entirely dependent on the context of where they appear. Both have a very long lower wick, at least twice the size of their small body, and little to no upper wick. Imagine this shape. It looks like a hammer. When this pattern appears at the bottom of a downtrend, we call it a hammer. The story it tells is incredibly bullish. It says that during the session, sellers continued their assault, pushing the price significantly lower. But then a powerful wave of buyers entered the market, rejecting those low prices and driving the price all the way back up to close near where it opened. It's a picture of the market hammering out a bottom. It's a potential sign that the sellers are exhausted and the buyers are starting to take control. Now, take that exact same candle shape and place it at the top of an uptrend. It's no longer a hammer. It's called a hanging man. The story it tells is now bearish. It suggests that even though the market is in an uptrend, a large amount of selling occurred during the session. While buyers managed to push the price back up by the close, that long lower wick is a warning. It shows that the foundation of the uptrend might be cracking. It's a sign of potential weakness. Same candle, different location, completely different meaning. Context is everything. The mirror images of these are the inverted hammer and the shooting star. Again, they look identical. A long upper wick and a small body at the bottom. When you see this shape after a downtrend, it's an inverted hammer. It tells us that buyers tried to rally and push the price up, but sellers pushed it back down. Now, you might think that sounds bearish, but in the context of a downtrend, it's actually a potential sign of bullishness. It shows that for the first time in a while, buyers are starting to test the waters and show some strength. It's a sign of potential change. But if that same shape appears at the top of an uptrend, it's called a shooting star. And it is a classic, powerful bearish reversal signal. The story is clear. The market was rallying, buyers pushed the price even higher. But then they hit a brick wall of sellers who came in with overwhelming force, slapping the price all the way back down. It looks like a star falling from the sky, signaling that the rally may be over. Seeing a shooting star form right at a major resistance level you've identified is one of the clearest signals the market can give you that the sellers are defending that territory. Similarly, seeing a hammer form right on a key support level is a powerful confirmation that buyers are stepping in to defend that price. These single candles are the market's way of validating the levels you've drawn on your chart. They are the evidence. But the story gets even deeper when candles start working together. Let's look at one of the most respected two-candle patterns, the engulfing pattern. A bullish engulfing pattern occurs at the bottom of a downtrend. You have a red, bearish candle, followed by a larger green, bullish candle that completely engulfs the body of the previous candle. The story here is a dramatic power shift. The market was in seller territory, but in a single session, the buyers not only negated all the sellers' progress from the previous session, but they pushed the price even higher. It's a complete reversal of sentiment, and a very strong signal that a new uptrend could be starting. The bearish engulfing is the exact opposite. At the top of an uptrend, you have a green candle followed by a larger red candle that completely engulfs the green one. This shows a sudden and decisive takeover by the sellers. They wiped out all of the buyers' gains from the previous session and then some. It's a powerful signal that the rally has run out of steam and sellers are now in control. These patterns are not just abstract shapes. They are visual representations of market psychology. They show you the moments of fear, greed, indecision, and conviction. Learning to read them is like learning to read the emotional state of the market. It's not about memorizing 50 different patterns with fancy names. It's about understanding the logic behind a few of the most powerful ones. Ask yourself, what story is this candle or this pair of candles telling me about the battle between buyers and sellers right now, at this specific location on my chart? When you combine this understanding with the market structure we discussed, the trends, the highs and lows, and the critical zones of support and resistance, you elevate your analysis to a whole new level. You're no longer just guessing where the price might go. You are waiting for the market to arrive at a key level you've identified, and then you are watching for the candles to give you a clue, a confirmation that a turn is likely to happen. This is how you begin to build a framework for making informed trading decisions. You're moving from a reactive, emotional approach to a proactive, strategic one. We've now decoded the language of price. We understand market structure, we can identify key levels, and now we can interpret the candlestick signals that form at those levels. So what's next? How do we put all of these pieces together to create a repeatable process? In the next part, we will begin to synthesize this knowledge, introducing technical indicators that can help us confirm momentum and filter our trade setups, moving us one step closer to building a complete trading plan. So, how do we add layers of confirmation to our price action analysis? We do it by introducing technical indicators. Now, I want you to think about these indicators not as magic crystal balls that predict the future, because they absolutely do not. Instead, think of them as the dashboard in a pilot's cockpit. The pilot's primary skill is flying the plane, feeling the controls, looking out the window. That's our price action analysis. The indicators on the dashboard, the altimeter, the airspeed indicator, the fuel gauge, they don't fly the plane, but they provide critical data that confirms what the pilot is sensing and helps them make more informed decisions. They add objectivity to a subjective process. We're going to focus on 3 of the most widely used and effective types of indicators that, when used together, can create a powerful system of checks and balances for your trading ideas. We'll start with the foundation, moving averages. A moving average does exactly what its name suggests. It calculates the average price of a currency pair over a specific number of periods, and it plots that average as a smooth, flowing line on your chart. Its primary purpose is to smooth out the noise of day-to-day price fluctuations and help you see the underlying trend more clearly. If the price is consistently trading above a rising moving average, it helps to confirm an uptrend. If the price is consistently below a falling moving average, it helps to confirm a downtrend. There are 2 main types you'll encounter: the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA gives equal weight to all prices in the period. So, a 50-period SMA just adds up the closing prices of the last 50 candles and divides by 50. It's simple and straightforward. The EMA, on the other hand, gives more weight to the most recent prices. This makes it react a little faster to new price changes. There's no better one. Traders just have different preferences. Many find the EMA more responsive for shorter-term analysis, while the SMA is often preferred for a smoother, long-term trend view. The real power comes from the periods you choose. 2 of the most watched moving averages in the entire financial world are the 50-period and the 200-period. The 200-period moving average is often seen as the ultimate line in the sand between a long-term bull market and a bear market. When price is above the 200, institutions are typically looking for buying opportunities. When it's below, they're looking for selling opportunities. The 50-period moving average acts as a medium-term trend indicator. Here's how we use them together. When the faster 50-period moving average crosses above the slower 200-period moving average, it's known as a golden cross, a historically bullish signal. Conversely, when the 50 crosses below the 200, it's a death cross, a historically bearish signal. More than just crossovers, these moving averages often act as dynamic levels of support and resistance. In a strong uptrend, you will often observe price pulling back to the 50 EMA, finding support, and then continuing its upward move. It's like a gravitational line for the trend. By waiting for price to pull back and test a key moving average, you can potentially find a much better entry point than just chasing the price higher. But how do we know if a pullback is just a healthy pause or the beginning of a full-blown reversal? A moving average alone can't tell us that. We need a tool to measure the momentum or the speed and strength of the price movement. This is where our second indicator comes in, the Relative Strength Index, or RSI. The RSI is what's known as an oscillator. It's plotted on a separate window below your main price chart and moves between 0 and 100. Its job is to measure the speed and change of price movements, essentially telling you when a currency pair might be overbought or oversold. The standard settings use two key levels, 70 and 30. When the RSI moves above 70, it suggests that the market might be overbought, meaning the uptrend has gone very far, very fast, and might be due for a pullback or consolidation. When the RSI goes below 30, it suggests the market might be oversold, meaning the downtrend has been aggressive and could be running out of steam. Now, this is a critical point that trips up most beginners. An overbought signal is not an automatic signal to sell, and an oversold signal is not an automatic signal to buy. In a very strong trend, the RSI can stay overbought or oversold for a very long time. Using it this way is a recipe for fighting strong trends, which is a losing game. So, how should a savvy trader use it? As a confirmation tool. Let's go back to our uptrend example. Price is above the 50 EMA, and it pulls back to test it. We're thinking about buying. We look down at our RSI. If the RSI has dipped down near or below the 30 level during this pullback, it adds a powerful layer of confirmation. It tells us that the selling momentum on this pullback is potentially exhausted, right at a key area of potential support, the 50 EMA. This combination is far more compelling than either signal in isolation. The RSI also has an advanced concept called divergence, which can be an early warning sign of a potential trend change. Bullish divergence occurs when the price makes a lower low, but the RSI makes a higher low. This suggests that even though the price fell, the momentum behind the selling is weakening. Bearish divergence is the opposite. Price makes a higher high, but the RSI makes a lower high, suggesting the buying momentum is fading. These aren't trade signals on their own, but they are giant blinking lights telling you to pay close attention. So now we have a tool for trend, moving averages, and a tool for momentum, RSI. Let's add our third and final indicator for this core toolkit, one that cleverly combines both trend and momentum, the MACD, which stands for Moving Average Convergence Divergence. The MACD might look complicated, but it's actually quite intuitive. It consists of three parts. First, the MACD line itself, which is typically calculated by subtracting the 26-period EMA from the 12-period EMA. Second, the signal line, which is a 9-period EMA of the MACD line. And third, the histogram, which represents the distance between the MACD line and the signal line. Forget the math. Here's what it all means. The core signal is the crossover. When the MACD line, the faster line, crosses above the signal line, the slower line, it's considered a bullish signal, suggesting that upside momentum is increasing. When the MACD line crosses below the signal line, it's a bearish signal, suggesting downside momentum is picking up. The histogram gives you an even clearer visual. When the histogram bars are above the zero line and growing taller, it shows strong increasing bullish momentum. When they are above the zero line but getting shorter, it shows that bullish momentum is fading. The same is true in reverse for bars below the zero line representing bearish momentum. Let's synthesize all three of our new tools into one cohesive idea. Imagine the euro to US dollar is in a clear uptrend, trading well above its 50 and 200 EMAs. Price then pulls back and touches the 50 EMA, a potential area of dynamic support. We look down at our RSI and see that it has dipped into oversold territory below 30. That's two checks in our favor. Now we look at our MACD. We see that during the pullback, the MACD line dipped below the signal line, but as price finds support at the 50 EMA, the MACD line begins to curl back up and crosses above the signal line. This is the confluence we're looking for. We have the long-term trend in our favor, price above MAs. We have a potential area of value at a dynamic support level, the 50 EMA. We have an indication that the selling pressure of the pullback is exhausted, RSI oversold. And finally, we have a signal that momentum is shifting back in the direction of the primary trend, the MACD bullish crossover. Each indicator on its own provides a small piece of the puzzle, but when combined, they paint a much clearer picture, helping to filter out low probability setups and highlight high probability ones. They move us from simply guessing where support and resistance might be, to having a dynamic data-driven system for confirming our analysis. Remember, price action is what we trade, but indicators are how we build our case. They are the evidence we present to the jury before we risk our capital. With this framework in mind, we are now ready to assemble all these individual components: market structure, support and resistance, candlestick patterns, and confirmation indicators, into a single cohesive trading plan. This trading plan is not just a document, it's the constitution for your trading business. It's the pre-flight checklist a pilot runs through before every single flight, regardless of whether they've flown one time or 10,000 times. It is the single most critical element that separates disciplined, systematic trading from emotional, reactive gambling. Without a plan, you are simply clicking buttons based on feelings. With a plan, you become the operator of a system. So let's build one piece by piece. Your personal trading plan should be a written document, either digital or physical, that you review before every single trading session. It needs to be clear, concise, and non-negotiable. First, you must define your universe. What are you going to trade and when? You can't analyze all 28 major currency pairs across 9 different time frames. That's a recipe for paralysis. A beginner might choose to focus on just 2 or 3 major pairs like the euro versus the US dollar, or the British pound versus the US dollar. These pairs typically have high liquidity and tighter spreads, making them a common starting point. Next, choose your primary time frame for analysis. Are you a swing trader looking at the 4-hour and daily charts? Or a day trader focused on the 15-minute and 1-hour charts? For this example, let's say we're focusing on the 4-hour chart for our primary analysis. This choice dictates the pace of your trading and how often you'll need to check the markets. With our what and when defined, we move to the heart of the plan, our exact criteria for entering a trade. This must be a rigid step-by-step checklist. Let's create a hypothetical set of rules for a long or buy trade using everything we've learned. Rule number 1, market structure. The 4-hour chart must be in a clear uptrend, defined by a series of higher highs and higher lows. We do not buy in a downtrend period. Rule number 2, area of value. Price must pull back to a pre-identified key level of support. This could be a horizontal support zone we drew in Part 6, a major Fibonacci retracement level, or a dynamic support level like a 50-period moving average. We don't chase price, we let it come to our zone. Rule number 3, candlestick confirmation. At our identified support level, we must see a clear bullish candlestick pattern form. This could be a bullish engulfing, a hammer, or a morning star pattern, as we discussed in Part 7. This is our signal that buyers are stepping back into the market at this key level. Rule number 4, indicator confirmation. Our confirming indicator, let's say the RSI, must show bullish divergence or be rising from oversold territory. This adds an extra layer of evidence that momentum is shifting in our favor. Only if all 4 of these conditions are met, without exception, do we even consider taking the trade. For a short or sell trade, the rules would simply be the mirror opposite. A clear downtrend, a pullback to a key resistance level, a bearish candlestick pattern, and confirmation from our indicator showing bearish momentum. This checklist removes ambiguity and emotion. It's either a valid setup according to your plan, or it isn't. There is no in-between. Now, for arguably the most important part of your entire trading plan, risk management and position sizing. Before you ever enter a trade, you must know 2 things: exactly where you're wrong, and exactly how much you stand to lose if you are. This is where we define our stop loss. The stop loss is a preset order that automatically closes your trade at a specific price to cap your losses. Its placement is not arbitrary. It should be placed at a logical level that invalidates your entire trade idea. For our long trade example, a logical stop loss would go just below the low of our bullish candlestick pattern, or just below the entire support zone. If price goes there, our reason for entering the trade, that buyers were in control at this support level, is proven incorrect. Once you know where your stop loss is, you can calculate your position size. A widely adopted principle in risk management is to risk only a small percentage of your trading capital on any single trade, often cited as 1 to 2%. Let's use the 1% rule for our example. If you have a $10,000 account, You should not risk more than $100 on a single trade. This is non-negotiable. This single rule is designed to help a trader withstand the inevitable strings of losing trades that every system experiences. So, how does it work? You know your maximum risk is $100. You know the distance in pips from your entry price to your stop-loss price. Let's say that distance is 50 pips. You simply divide your maximum dollar risk by the stop-loss distance in dollars per pip to get your position size. Your trading platform will help with this calculation. This ensures that whether your stop-loss is 20 pips away or 100 pips away, the total amount you lose if that stop is hit is always the same. $100 or 1% of your account. This is how professionals manage risk. They focus not on how much they can make, but on how little they can lose. With our entry and our risk defined, we need our exit plan for when the trade goes in our favor. This is our take profit level. A common approach is to use a risk-to-reward ratio. This means for every $1 you are risking, you aim to make a multiple of that. A standard minimum that many traders look for is a 1-to-2 risk-to-reward ratio. In our example, we risked $100. Therefore, our take-profit target would be set at a level that would give us a $200 profit. If our stop-loss was 50 pips, our take-profit target would be 100 pips away from our entry. Where do you place this target? You look for logical areas of resistance on the chart. Is there a previous high? A major resistance zone? A key Fibonacci extension level? Your target should be placed at a high probability area where sellers might step in. Sticking to a minimum 1-to-2 risk-to-reward ratio creates a positive expectancy. It means based on this model, you could be right only 50% of the time and still see your account grow over the long run, not accounting for fees and slippage. It's a game of statistics, not a game of being right every time. Finally, your trading plan must include rules for trade management and review. What will you do once you're in a trade? A common rule is to set it and forget it, letting the trade either hit your stop-loss or your take-profit without interference. This prevents emotional tinkering. Another approach might be to move your stop-loss to break-even once the trade has moved a certain amount in your favor, protecting your capital. And after the trade is closed, whether for a win or a loss, the work isn't over. You must keep a detailed trading journal. Record the date, the currency pair, the reason for entry, your entry and exit points, the final profit or loss, and most importantly, how you felt during the trade. Were you anxious? Greedy? Confident? This journal is your personal feedback loop. By reviewing it weekly, you'll spot patterns. You'll see which rules you're breaking, what setups are working best for you, and how your emotions are affecting your bottom line. This entire document, your pairs, your time frame, your entry checklist, your risk rules, your exit strategy, and your review process, this is your trading plan. It transforms trading from a chaotic, anxiety-inducing activity into a structured, business-like execution of a well-defined system. It is your shield against your worst emotional impulses, and your guide in the fog of market uncertainty. Your job is not to predict the future. Your job is to follow your plan. And that plan is your entire business. It's the operations manual for the most important startup you will ever launch. You Incorporated. Think about it. Every successful business in America operates on a plan. They have a mission statement, a budget, performance metrics, and a process for reviewing what works and what doesn't. Your trading should be no different. You are not a gambler pulling a lever in a casino. You are the CEO, the Chief Financial Officer, and the head of risk management for your own financial enterprise. Your trading capital is your business inventory. Your risk per trade is your operational budget. Your trading journal is your accounting ledger, meticulously tracking every single transaction, not just the numbers, but the reasoning and the emotional state behind it. At the end of every week, you, the CEO, must sit down and review this ledger. You must look at your performance not with the emotional sting of a loss or the euphoria of a win, but with the cold, analytical eye of a business owner. What were your best performing assets, your best trade setups? Where did you deviate from the business plan? Was it a calculated risk or an emotional mistake? This weekly review is non-negotiable. It's where the real learning happens. It's how you turn raw market data into personal wisdom. This mindset shift from trader to business owner is the single greatest leap you can make in your development. A business owner doesn't get emotional if one product line has a bad week. They analyze the data, adjust their strategy, and focus on the long-term profitability of the entire enterprise. They understand the concept of small incremental gains. They are not looking for a single lottery ticket win that makes them rich overnight. They are building a system that generates a small, consistent edge, and they apply that edge over and over and over again. That's the secret hiding in plain sight. The power in trading doesn't come from massive, high-risk home runs. It comes from the mathematical magic of compounding small, disciplined wins. Imagine a strategy that gives you a very modest but consistent return. Week after week, month after month. The initial results might feel boring. They won't make for exciting stories to tell your friends. But over years, the compounding effect of those small, steady gains can build a foundation of capital that is far more robust and sustainable than any account built on a few lucky, high-stakes gambles. Your goal is not to be a flash in the pan. Your goal is to still be here, trading your plan 5, 10, 20 years from now. Longevity is the ultimate victory in this field. To achieve that longevity, you have to become a lifelong student of the market. The course you've just completed is not a graduation ceremony. It's your enrollment. It's the foundation, the concrete slab upon which you will build your entire trading house. But the markets are not a static building. They are a living, breathing ecosystem. They evolve. Geopolitical landscapes shift, new economic policies are enacted, and technological advancements change the flow of capital. The strategies that work beautifully today might need tweaking 5 years from now. Your commitment must be to constant learning. Read books not just on trading but on psychology, economics, and history. Follow reputable financial news sources not to get trade signals, but to understand the macro narrative that is driving the markets. Find a community of serious, like-minded traders. Share your analysis, debate ideas, and hold each other accountable to your plans. But be selective. Surround yourself with people who talk about risk management and process, not the ones who just post screenshots of their winning trades. Your environment will shape your mindset. Choose it wisely. As we bring this journey to a close, let's zoom out and crystallize the core pillars we've built together. Think of them as the 4 unshakable cornerstones of your trading business. First, the fortress. This is your risk management. It is non-negotiable. It is the wall that protects your capital from the market's volatility, and more importantly, from your own worst impulses. It's your position sizing, your stop loss, your maximum daily loss limit. You build this fortress first, you make its walls thick and high, and you never ever abandon it. Second, the mirror. This is your trading psychology. It's the honest, sometimes brutal self-awareness of your own emotional triggers. It's understanding your relationship with greed, fear, and impatience. You cannot control the market, but you can, with diligent practice, control your reaction to it. The mirror forces you to take 100% responsibility for every single outcome. Your success or failure rests not on a particular indicator, but on the person you see in that mirror every morning. Third, the compass. This is your market analysis. It's your ability to read the charts, to understand price action, to identify key levels, and to build a contextual narrative for why the market is moving. Whether you use technical indicators, fundamental analysis, or a combination of both, your compass is what helps you form a high-probability thesis about future price direction. It gives you your bearings in the vast ocean of the market. And finally, the engine. This is your trading strategy. It's the specific set of rules that brings everything together. It takes the reading from your compass, operates within the walls of your fortress, and is executed by the disciplined mind you've cultivated in the mirror. It is the if-then system that dictates your exact entry, exit, and trade management criteria. It is the engine of your business, converting analysis into action. A fortress, a mirror, a compass, and an engine. Without any one of these, your structure is unstable and destined to fail. But with all 4, built with care and maintained with discipline, you have a robust framework for navigating the complexities of the foreign exchange market. I want to leave you with one final analogy. I want you to think of yourself as a professional pilot. A student pilot doesn't just jump into a 747 and hope for the best. They spend countless hours in the classroom learning theory, aerodynamics, meteorology, navigation. That's what this course has been. Then they spend hundreds of hours in a simulator practicing their procedures over and over until they are second nature. That's your demo account. They learn their pre-flight checklist and they follow it religiously every single time. That's your trading plan. When a pilot is flying, they don't control the weather. They can't stop the turbulence, the storms, or the crosswinds. The weather is the market. It is powerful, unpredictable, and must be respected. But the pilot does control the aircraft. They control their inputs, they trust their instruments, and they execute their plan. Their job is not to fight the storm. It is to navigate through it, manage the risks, and land the plane safely at its destination. Some flights are smooth. Some are incredibly turbulent. But the professional pilot's emotional state remains steady. They don't get euphoric on a clear day, and they don't panic in a storm. They simply fly the plane. They execute the process. That is who you must become. A pilot of your capital. Your mission is not the thrill of one turbulent flight. It is a long and successful career of safe landings. You have the theory. You have the checklist. You have the simulator. The journey from this point forward is yours to command. It will demand more discipline, more patience, and more resilience than you can probably imagine right now. But the skills you build along the way, emotional control, analytical thinking, and unwavering discipline, will serve you not just in trading, but in every single aspect of your life. This is the start of your flight. Do your pre-flight check. Trust your instruments, and focus on the journey one flight at a time. I wish you clear skies and a steady hand.